Taxes: sales tax, discounts, and income taxes. Before you begin, pause the video and download the marginal tax table from the handouts folder. You will need this table for the video and homework assignments this week. Personal finance includes every area of your life that involves money. It's about what you do with your money and how financial management will affect your future. If you recall, we have seen examples of sales tax in earlier units when dealing with percentages. Let's review. An exercise machine with an original price of $860 is on sale at 14% off. If the sales tax in your state is 6.5%, what is the cost of the exercise machine? First, we need to determine the discounted price. In order to do that, we're going to set up a proportion. Recall, if we are 14% off, that means we are going to be paying 86% of the original price. We cross multiply in order to solve any proportion, and we come up with our one-step equation. Divide through by 100, and we see that the discounted price of the exercise machine is $739.60. This is what's going to be taxed. If our tax rate is 6.5%, we can find the taxes by setting up a proportion and cross-multiplying. We get our one-step equation, and we see that the tax on the exercise machine was $48.07. Adding these two values together, we see the total cost of the exercise machine was $787.67. There are many types of taxes, including sales tax, gasoline tax, and property tax, but for most Americans, the largest tax burden comes from federal income taxes on wages and other income. The complete tax code is many thousands of pages long, and it changes almost every year as Congress passes new tax laws. Nevertheless, the basic idea behind income taxes is relatively straightforward. The purpose of this section is to be able to understand income taxes well enough to make intelligent decisions about both personal finances and political tax questions. Income tax is a percentage of your income collected by the government to fund its services and programs. The federal government collects income tax, and most but not all states do too. Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming have no state income tax. Tax revenue pays for our national defense, fire and police protection, road construction, public schools, public libraries, and public parks. Although the United States Congress determines federal tax laws, the Internal Revenue Service, or IRS, is the governing body that enforces the laws and collects taxes. Federal income taxes are a percentage of your taxable income, which is based on your earnings in the calendar year. Calculating your federal income tax begins with gross income or total income for the year. This includes, but is not limited to, income from wages, tips, interest or dividends from investments or savings accounts, unemployment compensation, profits from the sale of a business, rental income, and even game show winnings. The next step in calculating your federal income tax is to determine your adjusted gross income. These untaxed portions of gross income include contributions to certain retirement accounts and tax-deferred savings accounts, interest paid on student loans, and alimony payments. The tax code tries to encourage long-term savings by allowing you to defer income taxes on contributions to these accounts. Money that you deposit into these accounts is not taxed now. Instead, it will be taxed in the future when you withdraw the money during retirement. You are entitled to certain exemptions and deductions or subtractions from your adjusted gross income before calculating your federal income taxes. An exemption is a fixed amount on your return for each person supported by your income. You are entitled to this fixed amount for yourself and the same amount for any dependent. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. Most young people claim the standard deduction because their financial situations are relatively simple and are not eligible or do not have any itemized deductions. And itemized deductions are deductions you list separately if you have incurred a large number of deductible expenses. These deductions vary from person to person. The most common deductions include interest on a home mortgage, state income taxes, property taxes, contributions to charity, and medical expenses exceeding 7.5% of your adjusted gross income. When you file your taxes, you have two options for deductions. You can claim the standard deduction, which is determined by the IRS, or you can itemize your deductions. Note that you must claim either the standard or itemized deduction. Let's take a look at an example. Suppose you have the following deductible expenditures: $2,500 for interest on a home mortgage and $900 for contributions to charity. Your filing status entitles you to a standard deduction of $3,550. Should you itemize your deductions? Let's add up our itemized deductions. Again, the $2,500 plus $900 would entitle us to an itemized deduction of $3,400. You should instead choose to claim the standard deduction. By claiming the standard deduction, you are entitled to reduce your taxable income by more, thus paying less on income taxes. You always want to choose whatever the larger deduction happens to be. Let's recap how we can determine our taxable income. We start off with our gross income. We subtract any adjustments to give our adjusted gross income. From our adjusted gross income, we subtract any deductions and exemptions in order to arrive at our taxable income. Let's take a look at an example. Karen earned wages of $38,200, received $750 in interest from a savings account, and contributed $1,200 to a tax-deferred retirement plan. She was entitled to a personal exemption of $3,900 and to deductions totaling $6,100. Let's find her gross income, her adjusted gross income, and her taxable income. First, Karen earned wages of $38,200 and earned $750 in interest from a savings account, giving her a gross income of $38,950. In order to find her adjusted gross income, we're going to take out any adjustments or contributions she made to a tax-deferred retirement account. Recall that Karen contributed $1,200 to a tax-deferred retirement account, which qualifies as an adjustment to her gross income. Thus, her adjusted gross income is $37,750. To determine her taxable income, we want to take out the personal exemption and the standard deduction. If you remember, Karen took a personal exemption of $3,900 and claimed the standard deduction of $6,100, giving her a taxable income of $27,750. This is the amount the federal government is going to use to find Karen's federal income tax burden. The standard deduction and tax calculations depend on your filing status. There are four main types of filing status. Single, which indicates that you are unmarried, divorced, or legally separated. Married, filing jointly, you and your spouse file a single tax return. Married, filing separately, married and you and your spouse file two separate tax returns. Or as head of household, you are unmarried and paying more than half the cost of supporting a dependent child or parent. The marginal tax table allows you to determine how much tax you owe on your taxable income. The United States has a progressive income tax, meaning that people with higher taxable incomes pay at a higher tax rate. The system works by assigning different marginal tax rates to different income tax ranges or margins. Your tax bracket is the income margin or income range your taxable income falls within. For example, a single individual with a taxable income of $25,000 falls within the 15% tax bracket. Take a look at the marginal tax table on the following page. We will use this table to determine our federal income taxes in this class. Let's take a look at an example. Deidre is single with no dependents. Her adjusted gross income is $90,000. Calculate her income taxes for 2013. We always try to begin with their gross income. In this particular case, gross income was not mentioned. However, the first mention of income was her adjusted gross income at $90,000. From her adjusted gross income, we want to find her taxable income. In order to do this, we take out any exemptions or deductions. Since Deidre is single and has no dependents and makes no mention of her itemizing her deductions, we will assume she claims only one exemption for herself and claims the standard deduction for a person filing as single. That means that $90,000 is going to be subtracted by a single exemption of $3,900 and the standard deduction of $6,100 for a person filing as single, meaning her taxable income is $80,000. Now that we have Deidre's taxable income, we can use the marginal tax table to calculate her federal income taxes owed. Let's see how we're going to use the table to actually calculate the taxes owed for Deidre. Make sure we're looking at the first column because Deidre is filing as single. The tax table states that income in the amount from $0 to $8,925 will be taxed at 10%. Since Deidre has a taxable income over $8,925, we see that all of that amount is going to be taxed at 10%. So we set up a simple proportion. We cross multiply to figure out what 10% is going to be. We get our one-step equation, and we see that Deidre owes $892.50 in federal income taxes thus far. But since Deidre has a taxable income over $8,925, we need to move on to the 15% tax bracket. Taxable income from $8,925 up to $36,250 will be taxed at 15%. So that indicates that $27,325 of Deidre's taxable income will be taxed at 15%. Remember, the first or the original $8,925 has already been taxed at that 10% rate. We're going to set up our nice proportion and cross multiply to figure out what the taxes owed at the 15% marginal tax bracket are. We get our one-step equation, and we see that Deidre owes $4,098.75 in taxes for that bracket. But remember, she also owed from the earlier tax bracket, so thus far, Deidre owes $4,991.25 in federal income tax. Remember, she has paid taxes on a taxable income of $36,250 thus far. But if you recall, her taxable income was $80,000. So we need to move on to the next tax bracket. Taxable income from $36,250 up to $87,850 will be taxed at 25%. However, Deidre only has a taxable income of $80,000. So $80,000 minus $36,250 leaves me $43,750 to be taxed at 25%. Again, we're going to set up a proportion, solve this thing by cross multiplying, and we see that Deidre owes in this tax bracket $10,937.50. Altogether then, Deidre owes $15,928.75 in income taxes for the year.